Hello, welcome to the latest Any Answers Answered for accountingWEB. Tim and I are on the set recording Tax TV, and we're also recording an autumn statement special, which we'll make available to you in the near future. For today, though, we're going to look at a couple of questions which have been asked on Any Answers. The first one, it comes from a regular contributor, Clint Westwood, who has asked the following question. Now, I'm going to be honest with you, Tim, on this one. I read this question and failed the first test of exams. I didn't read the question properly, so I got it wrong. An individual dies, leaving a surviving spouse and son. His circumstances are very simple. His only assets are our bank accounts and quoted investments valued at £1 million, all held in joint names with his spouse, not as tenants in common. No house, no other complications. The will is equally simple. £325,000 or such lesser amount is available. In his estate passes to the son, the rest goes to the spouse. And so the question, a multiple choice. How much does the son get? Is it A, nothing, B, £325,000, or C, something else? Now my immediate reaction, £325,000 with £675,000 to the spouse. And I'd have been wrong.
Yeah, and as Clint points out in asking the question, he says at the bottom, PS, ignore the posting category tax. Would have selected other, but it's not an option. What he meant by that is that this is not a tax question, it's a probate question. And yet we're here on Tax TV, and the comments, there are 19 replies to this question, do then open up the tax issue. But the simple answer is that if all of the assets are held in joint names with the deceased and surviving spouse as the joint owners, then all the assets pass by survivorship and are outside the estate. So there is nothing in the estate, in which case the son gets nothing. So the simple answer is nothing. But it then opens up the question of, well, what is the tax treatment? Well, again, if all of the assets pass to the surviving spouse, there's no tax, spouse exemption. So Clint then goes on later in the thread to ask what would the position be if the assets were jointly owned by the deceased and a sibling. So let's suppose that, let's call him the dad who died. The dad and his sister, let's say, were the joint owners of the assets, and they pass by survivorship to the sister. They're still outside the estate for probate, but they nevertheless are relevant for tax. And what we have to do there is recognise that the deceased's interest in the jointly owned assets has passed to a surviving joint owner who is not a spouse, and they're not therefore eligible for the spouse exemption. We're still not going to give the son anything because it's outside the estate, but the nil rate band would be available on that disposition through the estate as a result of death to the co-owner. But there is the valuation question. And it was quite interesting looking at the replies. I don't think anybody had really had a look at the revenue manual guidance on this, which is fairly clear. Where you've got jointly owned assets, the revenue accepts that typically there will be a 10% discount in the value. So if the property we're looking at was worth £1 million, then instead of taking £500,000 as the taxable value, I would take 450,000. So I reckon in simple terms, you've got a transfer of value on death of 450,000, less the 325,000 nil rate band, leaves 125,000 at 40%. So there is a tax liability then of 50 grand. The comments in the thread did ask about who would suffer that tax liability. And the answer to that is that it would have to come out of the assets that the surviving co-owner has. So the recipient of the bequest on death would be subject to that because the estate hasn't got any funds with which to pay it. So the revenue would clearly expect the surviving sibling there to meet the IHT liability on my figures of 50 grand.
It shows very clearly, I think, that when we're looking at estate planning, we can't just look at the tax, as you say. We have to look first at who owns what. And the fact is that if we do have joint ownership, which isn't common tenants in common, we have joint ownership, the whole estate is irrelevant because those assets simply will not go into the estate. We then move on to specific legacies and what have you, and remainderment and all that sort of thing. But we have to make sure that the assets are held correctly in the first place, And as you say, there are then knock-on consequences as to what the rates of inheritance tax will be. A lot of people don't really look at it, but giving to charity, of course, can change the rate that you end up with. You also have certain exempt assets, gift to political parties perhaps, and as well as that, we also have to focus on exactly who owns what. Our second question this month is, in fact, two questions. Both relate to personal allowances and non-residency. The first question is from and I'm not sure if that's Dowland or D-Oland or what it is, but we'll say Dowland. Very simple question. An individual resident for tax purposes in Canada, not resident in the UK for tax purposes, are they entitled to claim a UK personal allowance? They are a British citizen, they have a British passport. Do they get a UK personal allowance?
Yes.
Very simple question.
Very simple question. I can remember, you probably can just, British subjects resident abroad. Of course, it's not just British subjects. As the postings in this thread point out, any citizen of any EEA member state, that's the European Economic Area, so that's the 27, is it 27 or 28?
Yeah.
28 member states at the moment, plus 3, the 3 being...
Norway, Switzerland, somewhere else?
Liechtenstein.
Ah, very good.
If you're a citizen of any of those 31 states, then you are entitled to a UK personal allowance. So the answer is yes, you do get the UK personal allowance, and that's relatively straightforward as an answer.
The second question, which is why we're doing them together, because they do fit together, a question from Jan CM. A non-resident landlord has approached me regarding the tax on his rental property. He hasn't paid any yet for the period he has been a non-resident landlord. As far as I'm aware, he should be entitled to a personal allowance as a UK citizen. But do we need to complete any paperwork in order to claim that personal allowance, or is it just assumed that you will get it?
What underlines this posting is the fact that the rental income or the net rental profit in the UK seems to be covered by the personal allowance, which is not that surprising. 11,000 is the personal allowance, and therefore there isn't going to be any tax to pay. But of course, as you and I know, that's not how the system works, and the non-resident landlord should most certainly have notified the revenue of that UK source of income, and they would then of course be able to claim the personal allowance when filing their self-assessment return that discloses that income. So there won't be any tax to pay, but yes, they certainly should have filed the return and notified the revenue. Of course, it could be that they're dealt with under the non-resident landlord scheme, in which case the tenant or agent acting for the landlord would have to deduct basic rate tax on the payments to the landlord. And in a case like this, the landlord would then need to claim repayment of those deductions, given that the rental is covered by their personal allowance.
Okay, so the point is that you do get automatically the allowance, but you have to do the correct paperwork to report the income in order to be able to deduct something from it.
That's right.
Okay, hopefully useful. I think some interesting questions there. Do remember, you can always get in touch with us through the Any Answers page, and perhaps next month your question will be the one that Tim and I discuss. But for this time, bye-bye.